And what we know about investment markets is to be invested for a long period of time, generating returns and compounding those returns is very, very powerful. The reality is that minimising loss in down markets is far more important for long-term success in investment markets than maximising gains in rising markets. So let's think about that. Most people are focused on the upside. What you need to do is be very focused on the potential downside in your portfolio. That is reflected in the old analogy of the tortoise and the hare. Everyone wants to be out in front, but the tortoise continues to grow. It continues to move forward. And what we know about investment markets is to be invested for a long period of time, generating returns and compounding those returns is very, very powerful. Statistically, that shows up in the numbers if I can just take you through those. If your portfolio drops by 10%, well, it grows by 11% to get back to where you are. If it drops by 20%, it has to grow by 25% to get back to where you are. But the power is, if your assets drop by 50%, they need to grow by 100% to get back to your starting point. So this is a concept which is really twofold. Most people, if they have a portfolio that drops by 50%, it's a circuit breaker. They are going to sell their assets, they're going to move out of the market, they're going to actually take themselves away from the potential to compound returns in the long term. So that's something we want to avoid. Something you want to consider is, what is your circuit breaker? If you had your portfolio fall by a certain value, what is the value of the portfolio that would cause you to panic, to give away or reconsider your long-term objectives when it comes to investing in the market? So if that number's 20%, well, construct a portfolio that potentially avoids a 20% fall. So when constructing a portfolio, and in our eyes a diversified portfolio, you need to be keenly focused on what the potential downside of the portfolio is. Not just statistically because you need that portfolio to grow after an inevitable downturn, but also you need to maintain your investment. We need to maintain the investment so we can enjoy the upside of the market and being invested for the long term. The concept of time in the market is linked to the idea of minimising the downside in the portfolio.
Thank you for listening to At the Helm with Will Douglas. Be sure to subscribe to this channel on YouTube. You can connect with Will by visiting kodacapital.com. The preceding content is information only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.